morning, everyone. Marty Missouri here, September 23rd, 2025. This morning, we're going to talk about a few things. I'm going to try not to keep you too long, but I think there's plenty going on that we need to talk about, or you need to hear from us about as it relates to how we're managing your money. That would be you client listeners out there, of course. And I want to start today with the dollar. The chart in front of you is the chart that I show you once or twice a week, and it's a one-year daily chart of the dollar index, DXY. And we have had call it one of the worst years in history, certainly the worst year in decades for the US dollar. And I've been talking about in here the likelihood of a technical bounce, of kind of a counter trend bounce. And actually, we were talking about it right here when it happened. But the dollar has rolled right back over and is now testing these lows from earlier this summer. So that, to me, it's quite obvious. It's the U.S. central bank recently cutting interest rates, forecasting a couple more for this year and more into next year to some degree. Despite, as I said the other day, also them increasing their outlook for GDP and for inflation. So that's kind of a head scratcher. The argument, I guess, is that the Fed funds rate, despite the fact that inflation is going to pick up a little bit, could be lower, all things relative. And definitely the potential weakness in the labor market. Powell said that was an insurance cut, and we'll see what happens thereafter. So anyway, we kind of beat that one to death the other day, and of course that's going to come up more. And so what I'm talking about the dollar here is how it can trade relative to interest rates globally. Now, the U.S. still has a somewhat relatively high rate among developed markets, but it's all about the trend and the potential rate of change. Europe, for example, which actually comprises about 58% of the dollar index, that would be the euro. The European Central Bank is on hold. So they're saying right now is we're going to wait and see how the data develop before we make another move with interest rates. And the Fed has said we're going to be lowering interest rates. So the interest rate differential is tightening between the US and the Eurozone. Therefore, the attractiveness from a yield standpoint of the dollar is going to be waning. And then, as I'm going to show you here as well, futures traders are really making a commitment to a lower dollar going forward. So here is from our notes, and this is actually, I just copied and pasted from my email reply to a good friend of mine who sent me a Financial Times article that talked about how foreign investors are buying equities, but they're hedging those dollar risk in those equities like they almost never do. So here's what I said. It's very interesting. The big-time currency hedging of U.S. equity positions makes sense relative to somewhat diverging or perhaps pace of monetary policies, as I just explained. And I suppose it could signal a readiness to unload U.S. equities when a catalyst emerges. So if you're a foreign investor and you've made a dollar commitment, so to speak, by buying U.S. equities, but you're concerned that may reverse, you hedge your dollar risk so you don't get beat up too badly. So it could be, again, that perhaps you could say this signals a readiness to sell U.S. stocks. For myself, it makes me a bit nervous over the potential for a serious dollar squeeze when a catalyst emerges, meaning serious strength in the dollar, if for whatever reason a hot CPI number in the U.S., better than expected data relative to the rest of the world, etc. And here is a bit from that Financial Times article. The dollar is getting beaten up. It has dropped by more than 10% so far this year, with still more than a quarter left in 2025. That would already make this the weakest year for the world's dominant trade and reserve currency in more than 2 decades, carving out declines against every other major currency on the planet. How about that? Okay, so clearly this is not the result of a mass rush out of U.S. assets. The buoyant stock market kills that idea pretty comprehensively. Now, I will say there was a stretch earlier in the year when I think we were seeing an exodus of U.S. assets. Fund managers were selling U.S. stocks and buying foreign stocks, Europe in particular, and I think that had a not small effect on the dollar as it weakened earlier in the year. But now investors have come back, clearly, but they're also hedging, or in one form or another, shorting the dollar along the way, expecting it to go down. And of course, that activity in and of itself can be quite the headwind for the dollar. What this means is that, sure, foreign investors still want to buy stocks in fast-growing companies, and those fast-growing companies tend to live in the U.S., especially in its tech sector. On a near daily basis, at least one investor has brought up the adage by former Citi chief executive Chuck Prince from 2007, that as long as the music is playing, you've got to get up and dance. And I think that really characterizes this market. Why, in the face of the heaviness of the technicals that I keep showing you, in the face of extreme valuations, the market keeps going up. Chuck Prince said that about essentially the mortgage securities market back in 2007. And that, of course, ended in his company's demise. So got to be careful with that sort of thinking as we get further on into bubbly territory. And then here's just a chart. The hedged ETF flows, they're actually hedging the dollar here, and you look at a 3-month rolling basis here. So as you can see, that doesn't happen very often, and it hasn't happened like this remotely in the last 5 years. So that is a clear commitment to the notion that the dollar has further downside in it. Now, we believe that long-term, absolutely, the trend in the dollar is going to be lower. Now, there's counter arguments to that. That's a pretty firm thesis of ours. We'll be willing to change our mind when we have reason to, but right now, that makes a lot of sense to us. And our portfolio moving more toward that thesis over the last year or so has made for a very, very good year for us so far, because again, this is what we think is a microcosm of what's going to happen long term, and we're positioned for that. Hence my little bit of nervousness that if we get a dollar spike, we've got to contemplate what that's going to mean for our core portfolio. So we're looking right now very deeply, stress testing, as I mentioned the other day, playing with various hedging strategies and so forth. We haven't made any moves yet, and it's been good not to. Right now, our core is up 32 basis points, while the S&P is actually down 10 basis points so far today. And that's just one day, so take that with a grain of salt. So just to illustrate again the bearishness in the dollar, this is the net positioning as of last week for non-commercial, call it speculators, in dollar futures positions. And look at the massive drop this last week in net short positions, bets that the dollar is going to continue to fall. Among asset managers hedging their dollar risk, meaning they're actually exposed negatively to a falling dollar, therefore they're hedging that with short positions in dollar futures. And then leverage funds, which are pretty much speculators, you can see they spent a week bullish the dollar, and then they went notably net short the dollar. So as I said in my email to my friend that I read to you, my concern right here is that we get some massive dollar squeeze, and suddenly these people have to cover those short positions in those people who are hedging their ETF equity positions and that sort of thing. So we'll see. It's going to be very, very interesting. The chart itself is not showing me, much at all. I would say that's an ambiguous chart. You could argue that right in here, it's not a negative divergence. It's just momentum confirming the downtrend in the dollar right now. Okay, so let's talk about the stock market for a minute. So yesterday I posted this, and I took a bit of the intro from GQG Research's excellent article, and there's a link, by the way, in that blog, and I think you should read it. And it really is a very thoughtful article on why they've been very, very bullish AI stocks until recently. So I essentially found myself talking about this a lot lately in client conversations. So I just bolded the areas that are pretty consistent with my conversation. And just in the interest of time, I'll just read the bolded areas. Since the 2008 financial crisis, the U.S. tech sector has been clearly the standout investment trade. In a growth-starved, zero-interest rate world that continuously drove capital towards secular growing compounders, this was the perfect setup for massive outperformance. This sector stands at a significant inflection point. I do believe this, with investors seemingly making a one-way bet on AI mania while appearing to ignore alarming fundamental issues. The momentum in these growth-oriented segments of the market, including big tech and companies tied to AI infrastructure build-out, could reverse at any moment. The next few years for the sector will be defined by deteriorating fundamentals, lower growth, higher competition, and greater capital intensity. We are not perma-bears on the tech sector. We own it. It's about 10% of our equity exposure. However, our views on the sector have shifted. Given our goal of capital preservation during downturns and our natural inclination to forego some upside, you have to be willing not to play in bubbly markets if you're concerned about how they tend to unravel. Again, our natural inclination to forego some upside possibilities in favor of maximizing potential long-term compounding. We would be remiss if we didn't raise the question, how much of this stuff do you really want to own when you have these dynamics? Most money managers today do not carry the scars of the dot-com era. Get this, of the approximately 1,700 active large cap U.S. portfolio managers, 4% personally experienced the dot-com bubble. I actually did. I started in 1984, believe it or not. During the dot-com crash, Microsoft and Cisco lost a third of their value in a matter of a week. Amazon shed nearly 80% of its value over 12 months. Now, from peak to trough, the 30-month experience, Cisco went down 80%. Amazon went down like 90%. In December of 2000, several quarters after the peak, analysts were still forecasting nearly 9% earnings growth for 2001, and folks were getting pretty amazing forecasts for next year right now. Many leading companies like Microsoft continue to grow enviably well in the years following the bubble burst, which brings to mind Howard Marks' view that there are no bad assets, only bad prices. Today feels like an era where bad prices are rampant, and as I said, I'm in that 4%. So we'll get to the charts here in a second. I found it interesting that China continues to shed holdings of U.S. Treasuries. They're down to $731 billion. So that's really been declining. They've been buying gold, which has been good for us. And I'll show you the gold chart here in a minute and talk about my short-term concerns. And, there's more, but in the interest of time, let's just jump over to the charts. So the S&P 500, I have up here the monthly chart. And I keep making the point because this is a 30-year chart that shows that every single time the S&P 500 was overbought on a monthly basis via the relative strength index, it suffered a double-digit correction. So this may be the first time in 30 years that we resolve that without that, but it just is a reason to be careful right here. The one-year daily chart is, again, markets peaking its way into all-time high territory against bearish momentum divergences, both on the MACD and very overbought on the RSI on a daily basis. NASDAQ 100 just marching its way higher against heaviness in momentum. Again, not a sell signal until it breaks notably below that trend line right there. And it hasn't done that yet, threatening it a little bit today. Russell 2000 small caps, I thought I'd throw up this 5-year chart for you because right now, as we speak, the Russell is trying once again to break above all-time highs that it set back in 2021. So it's been 4 years. So here, everybody's talking about how the market's doing so great. Well, 2,000 U.S. companies are still now, I guess, barely above where they were in 2021. We actually added small caps to our core portfolio much earlier than we tend to. We tend to kind of stay away from small caps until after a recession. Then we want to load up on them at the beginning of an expansion. But we have to acknowledge the fact that maybe this time is a bit different with all the stimulus that's being willing to be brought to bear. Maybe we can engineer that soft landing. So small caps looked attractive. We're glad we bought them. They're breaking into new all-time high territory. We'll see. They could actually, get there with some momentum, and then this would be support. The last time it threatened that was at the end of last year, and I can tell you there's nothing worse than a failed breakout. That's quite the decline once that breakout ultimately failed. So there's definitely that risk here as well. I thought I'd also show you the equal weight index, or this is the ETF that tracks it. It made its all-time high back in November of last year, and that has been resistance ever since. And right now, it is just trying its darndest to break into new all-time high territory. Now remember, folks, this is the S&P 500, the same S&P 500 that hits the headlines every day. The difference is that one is capitalization weighted, meaning it's the big cap stocks that do the heavy lifting. This one is all the same stocks, it's just that each stock has equal weighting in the index. So you can see this has not been a party that's been enjoyed by the rest of the market. It's been very, very concentrated. And the history of super concentrated markets isn't that great in terms of how they resolve themselves. So again, another reason to play some defense in your portfolio. Yields have come up a bit. Again, here we had the Fed cut interest rates, and then we had the 10-year yield go up, not as dramatically as in 2024, but still it questions whether the Fed should be cutting interest rates right here. Here's a buy signal on the MACD. We'll see. I'm not super bullish on interest rates going higher because we do have some concerns over the economy. Gold is getting pretty ridiculous. I was concerned about it up in here. We had these huge momentum divergences. Here we are, overbought in all-time high territory. Still have the momentum divergence on the MACD. I talked about it here. Looks like it's breaking down, and then kaboom. Here it is jumping up. The fact that gold and stocks are hitting all-time highs at the same time is not that usual, if you will, and some could argue that it's telling two different stories in here. But keep in mind, there's also a lot of central bank buying. This pretty big gaps right here. My guess is that they will get filled and that we will go lower, but I've been guessing that for a while. But we're going to keep hedging our gold position, not as aggressively right now as we were back in here. But, we're sure glad we own it. And so far, we're glad we haven't cut our exposure. We've chosen just to hedge the downside using put options right now. Lastly, I did want to show you the VIX again. Another thing that's been going on is that the VIX continues to make higher lows in here. So here we are moving into all-time highs. And here the VIX is going up. Now the VIX is a volatility index. It is the cost of implied volatility in S&P 500 index options. And typically when the VIX is rising, the price of that volatility is rising, obviously, but it also says something about what options traders are doing position-wise under the surface. It suggests that they're beginning to price up downside risk in the market. And what I've shown you here is over the last 5 years where the market is moving higher and volatility is moving higher. That has preceded some pretty decent corrective action at points. These are probably mid to high single-digit declines. This was a 27% decline. And here we are then. So again, just another red flag that says this market is getting extended pretty long in the tooth. Now, having said all that, it wouldn't surprise me to see this continue, even through the end of this year with the fourth quarter coming up and so on. Wouldn't surprise me either way. But going into next year, if we continue to sustain these sort of indicators, or if they continue to show what they're showing, next year is going to get precarious. So we'll stay on our toes and continue to do the work and assess the data as well as the technicals. Folks, thank you as always for watching and listening, and I'll be back later in the week. Take care. Bye-bye.